Imagine putting your money somewhere and then simply walking away from it for 10 years, not checking it every day, not panicking when the market falls, not celebrating when it rises, just leaving it completely alone, and then coming back one fine day to find that what you left behind has turned into something so large, so powerful, and so life-changing that you can hardly believe your own eyes. That is not a fantasy. That is not a get-rich-quick scheme. That is not something reserved for the wealthy or the genius. That is the core idea behind Coffee Can Investing, a book written by Saurabh Mukherjea, one of the most respected investment thinkers to come out of India, and a man who has spent decades watching investors make the same painful mistakes over and over again, and then quietly figured out a better way. This book is not just a collection of financial advice. It is a deeply researched, carefully argued, and passionately written case for a completely different way of thinking about wealth, about the stock market, about time, and about human behavior. It speaks not just to investors in India, but to anyone anywhere in the world who has ever wondered why their money never seems to grow the way they hoped it would, why the stock market feels like a casino, why the rich keep getting richer while ordinary people keep losing, and whether there is a simpler, smarter, and more reliable path to financial freedom. The title itself comes from a story that is over 100 years old, and that story alone is worth understanding before we go any further, because it sets the entire tone of what this book is really about. Back in the early days of the American West, when there were no banks in many small towns, and people had no safe place to keep their valuables, ordinary families would often take their most important and valuable possessions, whether it was gold coins, deeds to their land, or certificates of stock ownership, and they would simply put them in a coffee can. That coffee can would then be buried under the floor of their house or placed at the back of a shelf somewhere, and it would be left there, untouched, undisturbed, forgotten about for years and years. The people who did this were not financial geniuses. They were not traders or speculators or experts in any kind of market. They were just ordinary people who trusted in something, put it away, and let time do the work. The remarkable thing is that when these coffee cans were eventually opened, sometimes many years later, the contents had often grown enormously in value. The stocks they had put inside had compounded year after year, multiplying in ways that no one could have predicted at the time of putting them in. This simple observation, this quiet wisdom, from a time before smartphones and stock tickers and 24-hour financial news channels, is the foundation of everything that Saurabh Mukherjea argues in this book. Now, before going any further, it is important to understand who Saurabh Mukherjea is and why his perspective on investing matters so much. He is the founder of Marcellus Investment Managers, a company based in India that manages money for a relatively small number of very serious investors. Before starting Marcellus, he worked at some of the most respected financial institutions in the world, including CLSA, which is one of the most influential brokerage firms in Asia. Over the course of his career, he has spent thousands of hours studying companies, reading annual reports, meeting with management teams, and trying to understand why some businesses succeed over long periods while others fail, and why some investors consistently make money while most consistently lose it. The conclusions he has arrived at are not particularly complicated once you understand them, but they are deeply counterintuitive, meaning they go against what most people naturally feel and believe about investing. And that counterintuitive quality is actually one of the most powerful things about the coffee can approach, because the reason it works so well is precisely because almost no one has the patience and the discipline to actually do it. Let us now go much deeper into the core ideas of this book, one layer at a time, and let us try to understand not just what the author is saying, but why he is saying it, and why it matters so profoundly for anyone who wants to build real, lasting wealth over the course of their lifetime. The first thing the book asks you to understand is the nature of the Indian stock market, or really any stock market, and why it is so brutally difficult for ordinary people to make money in it. Most people who invest in stocks lose money. This is not a controversial statement. It is backed by decades of data from markets all around the world. The vast majority of individual investors, people who buy and sell stocks on their own, end up with less money than if they had simply put their savings into a basic fixed deposit at a bank. And even most professional fund managers, the people who are paid enormous salaries to pick winning stocks for a living, end up underperforming the market over any meaningful period of time. Why does this happen? The author goes into this with great care and depth. The first reason is the sheer cost of trading. Every time you buy or sell a stock, you pay a cost. In India, this includes brokerage fees, transaction taxes, and other charges. These costs seem small on any individual trade, but when you add them up over hundreds of trades across many years, they eat a very significant portion of your returns. The author uses many examples to show how even a small cost, when repeated many times over many years, can dramatically reduce the final amount of money you end up with. But the cost of trading is actually the smaller problem. The bigger problem is human behavior. This is where the book really starts to get fascinating, because the author digs deep into the psychology of investors and explains, with remarkable clarity, why our natural human instincts are almost perfectly designed to make us lose money in the stock market. Think about what happens when a stock market falls sharply. Prices drop dramatically. Fear spreads everywhere. The news is full of panic and doom. What does a normal human being feel in that moment? They feel afraid. They feel like they need to do something. They feel like they need to sell before things get even worse. And so they sell, often at the very worst possible time, locking in their losses just as the market is about to recover. Now think about what happens when the market rises sharply. Prices go up dramatically. Excitement spreads everywhere. The news is full of stories about people making huge amounts of money. Everyone seems to be getting rich. What does a normal human being feel in that moment? They feel excited. They feel like they are missing out. They feel like they need to buy before the prices go even higher. And so they buy, often at the very worst possible time, buying high just as the market is about to fall. This pattern of selling low in fear and buying high in excitement is the single biggest reason why most investors destroy their own wealth. And the cruel thing about it is that this is not stupidity. It is not a sign of poor intelligence or lack of knowledge. It is simply how human brains are wired. Our brains evolved over millions of years to respond to immediate threats and immediate rewards. They were not designed for the counterintuitive world of stock markets, where the best time to buy is usually when everything feels most terrifying, and the best time to avoid buying is usually when everything feels most exciting. The author makes this point very powerfully by showing data on how Indian mutual fund investors behave over time. What the data shows is deeply sad. Most people invest money in mutual funds during bull markets, when prices are already high, because that is when they feel confident and excited. And most people withdraw money from mutual funds during bear markets, when prices are low, because that is when they feel scared and want to stop the pain. The result is that even if a mutual fund delivers perfectly good returns over a long period, the average investor in that fund often ends up with much lower returns because of their own behavior of buying at the top and selling at the bottom. The coffee can approach, at its most fundamental level, is a solution to this behavioral problem. If you put your money into a carefully selected portfolio of great companies and then simply do not touch it for 10 years, you eliminate the possibility of making these costly emotional mistakes. You cannot sell in panic if you have committed to not selling. You cannot chase the next exciting stock if you have already decided that your portfolio is fixed. The very act of choosing to do nothing becomes your greatest protection against the most dangerous enemy you have as an investor, which is your own impulsive, emotional, short-sighted human brain. But of course, this raises an obvious question. What exactly do you put in the coffee can? You cannot just pick any companies and lock your money away for a decade, because some companies will fail, some will shrink, and some will simply disappoint in ways that leave you much worse off than when you started. The genius of this book is that it does not just tell you to be patient. It tells you exactly what you should be patient with, and it gives you a rigorous, data-backed framework for identifying the small number of companies that are genuinely worthy of that patience. This framework is built around a set of filters, specific criteria that a company must meet in order to qualify for inclusion in a coffee can portfolio. These filters are not arbitrary. They are drawn from decades of careful research into which companies in India have consistently created wealth for their shareholders over long periods and which have not. Let us go through each of these filters carefully, because understanding them is the heart of understanding the entire coffee can philosophy. The first, and perhaps most important filter, is revenue growth. The author and his team looked at data going back many decades in the Indian stock market, studying thousands of companies across hundreds of industries, trying to understand what distinguishes the great long-term wealth creators from all the rest. One of the clearest findings that emerged from this research is that companies which grow their revenue consistently, year after year, over a long period of time, tend to be far better investments than companies that grow in fits and starts, or that grow their profits through cost-cutting rather than genuine business expansion. The specific threshold that the author proposes is that a company should have grown its revenue by at least 10% every single year for at least the last 10 years. This is a demanding standard. Think about what it actually means. Not just occasional good years interrupted by bad ones, not just an average of 10% over the period, but 10% or more every single year for 10 consecutive years. When you apply this filter to the universe of listed companies in India, a very large number of companies are immediately eliminated because most companies, even good ones, do not manage to grow their revenue consistently at this rate over such a long, unbroken period. Why does consistent revenue growth matter so much? The author explains this in detail. Revenue growth is a sign that a company is genuinely creating more value for its customers year after year. It means that more and more people or businesses are choosing to buy from this company, which suggests that the company is doing something genuinely well, whether it is making a better product, providing a better service, building a stronger brand, or expanding into new markets. Revenue growth that is consistent, meaning it does not collapse during recessions or difficult periods, also suggests that the company has a genuinely durable business model, one that can withstand the inevitable challenges that all businesses face over a decade-long period. On the other hand, if a company is growing its profits without growing its revenue, that is a warning sign. It might mean the company is cutting costs, which is a strategy that has limits, because you can only cut so much before you start cutting into the bone of the business. Or it might mean the company is using accounting tricks to make its profits look bigger than they really are. Or it might mean the company is raising prices in ways that will eventually drive customers away. Consistent revenue growth, by contrast, is very hard to fake for 10 consecutive years, which makes it a much more reliable signal of genuine business quality. The second major filter is return on capital employed, often called by a shorter name among investors, but the idea is simple. It measures how efficiently a company uses the money that has been invested in it to generate profit. If a company takes 100 units of money invested in it and generates 15 units of profit from that investment, it is performing differently than a company that takes 100 units of invested money and generates only 5 units of profit. The first company is doing much better at turning capital into returns. The author proposes that a company should have generated a return on capital employed of at least 15% every single year for at least the last 10 years. Again, this is not just an average. It is a consistent standard, maintained year after year, that suggests the company has a genuinely powerful and durable competitive advantage. Why does return on capital employed matter so much? The author explains this beautifully. A company that consistently generates high returns on its capital is, in essence, a money-making machine. Every unit of profit that this company earns and reinvests back into its own business generates yet more profit, which in turn generates even more profit when reinvested again. This is the magic of compounding, and it is what separates truly exceptional businesses from merely good ones over long periods of time. A company with a low return on capital, by contrast, needs to reinvest large amounts of money just to keep growing. It is like a leaky bucket. You keep pouring water in, but a lot of it drips out, and you have to keep pouring more and more just to maintain the same level. This kind of company might look profitable on the surface, but it is actually destroying value over the long term because it is consuming more capital than it is efficiently deploying. The combination of these two filters, consistent 10% revenue growth and consistent 15% return on capital employed, both maintained over a period of at least 10 years, is extremely powerful as a screen for identifying great businesses. When the author and his team applied both filters together to the universe of Indian-listed companies, they found that only a very small number of companies, somewhere between 30 and 50, depending on the exact time period, met both criteria simultaneously. This small universe of companies represents, in the author's view, the cream of Indian corporate quality. Now, here is where it gets truly interesting. The author then looked at how these companies had actually performed as stock market investments over time. The results were remarkable. Companies that passed both filters had, on average, delivered returns that were far superior to the broader market over any 10-year period. They had compounded wealth at rates that turned even modest initial investments into very large sums of money. And crucially, they had done this without requiring investors to do anything clever or sophisticated. All you needed to do was identify these companies, buy them, and then do nothing for 10 years. The doing nothing part, counterintuitive as it sounds, was actually the most important part of the strategy. Let us now think about why these specific filters work, and why a company that meets both of them tends to be such a powerful long-term investment. The key concept here is what the author calls a clean business, and this phrase is central to the entire coffee can philosophy. A clean business, in Mukherjea's framework, is a company that does not need to engage in any morally dubious or legally questionable behavior in order to succeed. It competes on the genuine merit of its products and services. It treats its employees, its suppliers, its customers, and its shareholders fairly and transparently. It does not depend on connections to powerful politicians or bureaucrats. It does not engage in price fixing or collusion with competitors. It does not use aggressive or misleading accounting to make its financial results look better than they are. It simply builds something genuinely excellent and lets that excellence be the engine of its success. Why does this matter for investors? Because in India, as in many developing economies, a very large number of businesses operate in ways that are legally or ethically questionable. They may bribe officials to get contracts. They may cook their books to avoid taxes or attract investment. They may have related party transactions, meaning they do business with companies owned by the founder's family members in ways that siphon money away from ordinary shareholders. They may depend heavily on protection from the government or on subsidies that could disappear if the political environment changes. These kinds of businesses might look very profitable in the short term, and their stocks might even perform well for a while. But over a 10-year period, the ROT always tends to show. Regulatory crackdowns happen, accounting scandals are uncovered, political winds shift. And when these things happen, the stocks of such companies collapse, often catastrophically, wiping out the wealth of investors who did not look carefully enough beneath the surface. The companies that pass the coffee can filters, by contrast, are almost by definition clean businesses. You simply cannot grow revenue consistently at 10% a year for 10 years unless you are genuinely building something of value. You cannot maintain a return on capital employed of 15% or more for 10 consecutive years by cheating or cutting corners, because cheating and corner cutting are strategies with diminishing returns, and their costs always eventually catch up with the company that engages in them. Consistency over a decade is almost impossible to fake. So the coffee can filters serve a dual purpose. They identify companies with strong financial performance, yes, but they also, as a byproduct of that financial strength, identify companies that are likely to be genuinely well-run, genuinely ethical, and genuinely durable businesses. This combination is what makes the coffee can portfolio so powerful as a wealth creation tool. Now let us talk about the kinds of companies that typically pass these filters in India and what they have in common. The author discusses several sectors and industries in detail, and there are some clear patterns that emerge. Consumer goods companies, particularly those that sell everyday products to a mass market, tend to appear frequently in the coffee can universe. Think about a company that makes a soap that millions of Indian households have been buying for decades. Year after year, no matter what happens with the economy, people still need to wash their hands and their bodies. The company that makes their preferred soap continues to sell product, continues to generate revenue, and continues to earn good returns on its invested capital. The brand loyalty that has been built up over years makes it very difficult for a new competitor to displace the existing product, which protects the company's pricing power and its profit margins over long periods. Private sector banks and financial institutions of high quality also tend to appear in the coffee can universe, though the author is careful to distinguish between those that are genuinely well-run and those that merely appear to be so. The best private sector banks in India have compounded wealth at extraordinary rates for their shareholders over long periods, because banking, when done well and cautiously, is a business that naturally benefits from compound growth. A bank that maintains high credit quality, meaning it lends to borrowers who actually pay back their loans, and that manages its costs efficiently, can generate very consistent and very high returns on capital over many years. Healthcare and pharmaceutical companies of certain types also tend to appear. India has a very large and growing market for healthcare services and pharmaceutical products, and companies that have built genuine capabilities in research, manufacturing, or the delivery of healthcare tend to grow consistently over long periods, because the demand for these products and services is largely independent of economic cycles. Information technology companies, particularly those in the business-to-business services space, have been another area where many coffee can quality companies have emerged from India. The global demand for skilled software engineers and technology services has created a massive industry in India, and the best companies in this industry have compounded at extraordinary rates while generating excellent returns on capital, because the business model requires relatively modest amounts of physical capital to operate. What these very different kinds of businesses have in common is something the author calls a moat, a term popularized by the legendary American investor Warren Buffett, whose ideas the author frequently references and builds upon. A moat is a sustainable competitive advantage, something that makes it genuinely difficult for competitors to take away a company's customers or to replicate its success. Just as a moat of water around a medieval castle made it very difficult for invaders to attack, a business moat makes it very difficult for competitors to attack the company's market position. Moats can take many different forms. One of the most powerful forms is brand strength. A company that has built a genuinely beloved brand, one that customers trust deeply and choose reliably, has a moat that is very difficult to overcome. Building a great brand takes many years and enormous investment, and even then, it is far from guaranteed to succeed. So a company that already has one is sitting on a very valuable asset that competitors cannot quickly or cheaply replicate. Another powerful form of moat is distribution strength. In India, with its incredibly complex and diverse geography, distribution is one of the most significant challenges any business faces. A company that has built a deep, reliable distribution network across the country, reaching small towns and rural areas, as well as major cities, has a structural advantage that gives it access to customers that competitors with weaker distribution simply cannot reach. Building this kind of distribution network takes years and years of careful investment and management, which makes it very hard for a new entrant to replicate quickly. A third form of moat is technology or intellectual property. A company that has developed a proprietary technology, a unique manufacturing process, or a body of research that gives its products superior performance has a competitive advantage that is protected to some degree by the difficulty and cost of replicating that knowledge. This is particularly relevant in pharmaceutical and specialty chemicals companies, where the depth of scientific knowledge required to develop certain products creates a natural barrier to competition. A fourth form of moat is network effects. Some businesses become more valuable to each individual user as more users join the network. A payments platform is a good example. The more merchants accept a particular payment method, the more useful it is for consumers. The more consumers use it, the more attractive it is for merchants to accept. This virtuous cycle means that once a network business reaches a certain scale, it becomes extremely difficult for a competitor to displace it. The author is careful to point out that not all moats are permanent. Industries change. Technologies disrupt established business models. Consumer preferences shift. Regulations change the rules of competition. This is why the consistent performance requirement, meaning 10 years of strong revenue growth and high returns on capital, is so important. It is not enough for a company to have had a moat in the past. The fact that it has maintained strong performance consistently over the last 10 years suggests that the moat is durable and genuine, not illusory or already eroding. Let us now talk in more detail about what the coffee can portfolio actually looks like in practice and how an investor would go about constructing one. The author suggests that a coffee can portfolio should ideally contain somewhere between 10 and 15 companies. Fewer than that, and the portfolio is too concentrated, meaning a single bad outcome for one company could seriously damage the overall returns. More than that, and the quality of the individual selections tends to dilute, because there simply are not enough genuinely coffee can quality companies at any given time to fill a much larger portfolio without compromising on the standards. The process of constructing the portfolio begins with applying the filters. You look at the universe of listed companies, apply the revenue growth test and the return on capital test, and see which companies have met both criteria consistently for the last 10 years. In the Indian context, the author and his team have developed sophisticated tools and databases to do this analysis systematically, but even an individual investor with access to basic financial data can do a version of this screening. Once you have your filtered list, the work is not yet done. The next step is deeper qualitative research, meaning you actually look carefully at each company that has passed the quantitative filters to understand why it has performed so well, and to satisfy yourself that the reasons for its past success are likely to remain in place for the future. This involves reading annual reports, studying the competitive landscape, understanding the management team, and forming a view on whether the business model is likely to remain strong over the coming 10 years. The author places great emphasis on understanding the quality of management. The best businesses in the world can be destroyed by bad management, and mediocre businesses can be transformed by great management. In the context of Indian companies, which are often founder-led or family-controlled, understanding the culture and values of the leadership team is particularly important. The author looks for management teams that have a track record of treating minority shareholders fairly, that communicate transparently with investors, that do not engage in excessive self-dealing or related party transactions, and that demonstrate a long-term orientation in their decision-making. Once the portfolio is constructed, the coffee can rule is simple. You do not touch it for 10 years. You do not sell a holding because the stock price has gone up a lot and you want to lock in your profits. You do not sell a holding because the stock price has gone down a lot and you are afraid it might go down more. You do not sell a holding because a friend told you about a better opportunity. You do not sell a holding because you need money for something else, which is why the author emphasizes that you should only invest money in a coffee can portfolio that you are genuinely comfortable not touching for a decade. The only reason to sell a holding before the 10-year period is up is if the business itself changes in a fundamental way. If a company that was in your portfolio does something that suggests its competitive position is genuinely deteriorating, perhaps it loses a key customer, or a superior competitor emerges and takes significant market share, or there is evidence of serious accounting irregularities, or the management team engages in behavior that seriously damages your confidence in their integrity, then you might have grounds to reconsider. But the bar for such a reconsideration should be very high, and the default position should always be to stay the course. This discipline of doing nothing, of resisting the constant temptation to trade, to tweak, to optimize, to respond to the latest news or the latest market movement, is one of the most counterintuitive and also one of the most powerful aspects of the coffee can approach. In an age when financial information is available instantly, when prices are updated by the second, when it is possible to trade your entire portfolio with a few taps on a smartphone screen, the idea of simply not doing anything for 10 years seems almost absurd. But the data shows, unambiguously, that this apparent absurdity is actually the wisest course of action. The author illustrates this with powerful historical examples. He shows what would have happened if an Indian investor had constructed a coffee can portfolio at various points in the past and then simply left it alone. The results are consistently impressive. Even through periods of significant market turbulence, including global financial crises, domestic political upheavals, and industry-specific shocks, the coffee can portfolios of genuinely great companies have consistently delivered strong long-term returns, often far outperforming the broader market and certainly outperforming most active trading strategies. One of the most important sections of the book deals with the concept of compounding, and it is worth spending considerable time on this because it is the mathematical engine that makes the entire coffee can approach so powerful. Compounding is the process by which returns earned on an investment are reinvested, and then returns are earned on those reinvested returns, and so on, in a self-reinforcing cycle that accelerates over time. The author uses simple numerical examples to illustrate this. Suppose you invest a certain amount of money in a coffee can portfolio, and suppose that portfolio grows at a rate of 20% per year, which is roughly the kind of return that the best coffee can quality companies in India have historically generated. In the first year, the growth seems modest in absolute terms. In the second year, it is a little larger. In the third year, a little larger still. But as the years go by, the compounding effect begins to accelerate dramatically because you are earning returns not just on your original investment, but on all the accumulated growth of previous years. By the end of 10 years, at 20% annual growth, your original investment has grown by a factor of more than 6. By the end of 15 years, it has grown by a factor of more than 15. By the end of 20 years, it has grown by a factor of nearly 38. These numbers seem almost magical, but they are simply the result of the mathematics of compounding, and they work reliably as long as the underlying investments genuinely continue to compound at the assumed rate. This is why the choice of which companies to include in the coffee can portfolio is so important. You are not just choosing investments for the next quarter or the next year. You are choosing partners for a 10-year journey of compounding. A company that grows at a high rate and generates high returns on capital compounds much more powerfully than a company that grows modestly or generates mediocre returns on capital. And the difference between a great company and a merely average company, in terms of the final wealth created over a decade, is enormous. The author also makes a critically important point about the role of time in investing, and specifically about why starting early matters so much. If you start investing in a coffee can portfolio at the age of 30, and the portfolio compounds at 20% per year, then by the time you reach 60, you will have had 30 years of compounding working in your favor. The wealth created over those 30 years, thanks to the power of compounding, will be almost incomprehensibly large relative to what you put in. On the other hand, if you wait until 40 to start, you have only 20 years of compounding working for you, and the final result, while still impressive, will be dramatically smaller than what the 30-year head start would have produced. This is why the author argues so passionately that the most valuable thing a young person can do with their financial life is to start a coffee can portfolio as early as possible and then simply leave it alone. The time advantage that young investors have is the most powerful financial asset imaginable, and most young people have absolutely no idea how valuable it is. Let us now turn to a discussion of some of the specific companies that the author uses as examples of genuine coffee can quality businesses in India. While he does not recommend specific stocks as financial advice, he does discuss the characteristics that have made certain companies stand out as long-term wealth creators, and it is illuminating to understand what these characteristics look like in practice. One category of company that comes up repeatedly is what the author calls franchise businesses. These are companies that have built such a strong position in their particular market that they essentially operate with very little meaningful competition in their core business. The brand, the distribution network, the customer trust, and the operational capabilities that these companies have built up over decades create a competitive position that is genuinely very difficult for anyone else to replicate. The author discusses how these franchise businesses tend to share certain characteristics. They typically have very high customer retention rates, meaning that once a customer starts using their product or service, they tend to keep using it for many years. They have pricing power, meaning they can increase the price of their products modestly each year without losing significant numbers of customers, because the customers value the product too much to switch. And they have strong operating leverage, meaning that as the business grows, the incremental profit from each additional unit of revenue tends to be higher than the overall average profit margin, because the fixed costs of the business are spread over a larger revenue base. Another category that appears frequently is what the author calls capital-light businesses. These are companies that do not need to invest large amounts of money in physical assets, like factories, machinery, or real estate, in order to grow their revenue. The archetypal capital-light businesses in India are software and information technology services companies, where the primary assets are the skills and knowledge of the employees rather than physical infrastructure. Because these companies do not need to keep reinvesting large amounts of capital just to maintain their existing business, they are able to return more of their earnings to shareholders or to deploy capital into genuinely value-creating growth opportunities. The contrast with capital-heavy businesses is instructive. A steel company, for example, needs to invest enormous amounts of money in blast furnaces, rolling mills, and other infrastructure, and this equipment depreciates over time and needs to be replaced. Even if the steel company is profitable, much of that profit needs to be reinvested just to keep the existing machinery working, leaving relatively little left over to genuinely compound for shareholders. Over long periods, capital-heavy businesses in cyclical industries like steel, cement, and infrastructure tend to be far less attractive long-term investments than capital-light businesses in more stable, consumer-oriented sectors. This brings us to an important discussion of sectors and industries to be cautious about in the Indian context, and the author is refreshingly candid and specific about where he sees persistent risks for investors. Commodity businesses, meaning companies whose revenues are primarily determined by the global market price of a commodity like steel, aluminum, oil, or agricultural products, are generally unattractive as long-term coffee can investments. The fundamental problem is that commodity prices are determined by global supply and demand dynamics that are completely outside the control of any individual company, no matter how well run it is. Even the most efficiently managed steel company cannot control what happens to the price of steel, and when steel prices fall dramatically, even the most efficient producer will see its revenues and profits collapse. This makes consistent revenue growth of 10% a year extremely difficult for commodity businesses to achieve because their revenues are largely hostage to price cycles that are entirely outside their control. And it makes the return on capital very volatile because in good years, when commodity prices are high, returns can be excellent, but in bad years, they can collapse to very low levels or even turn negative. This volatility is the enemy of the consistent performance that coffee can filtering requires, and so commodity businesses very rarely pass the filters. Infrastructure companies, or companies that depend heavily on government contracts, also tend to be unattractive in the coffee can framework, and for related reasons. The revenues of these companies are highly dependent on decisions made by politicians and bureaucrats, which introduces a level of unpredictability and risk that makes consistent long-term performance very difficult. Moreover, these sectors tend to be riddled with the kinds of ethical complications, such as the need to pay bribes to secure contracts, that the author identifies as signs of a non-clean business. Public sector undertakings, meaning companies that are owned or controlled by the government, also tend to perform poorly over long periods as stock market investments in India, for reasons that are well documented and widely understood. Government-owned companies are often managed with political objectives in mind rather than shareholder value creation objectives, and they frequently carry excess employment, inefficient operations, and pricing constraints imposed by the government that prevent them from earning the kinds of returns on capital that a genuinely well-run private company could achieve. Real estate developers present another area of significant caution in the coffee can framework. The real estate development business in India has historically been associated with a very high degree of opacity, complex financial structures that are difficult to understand, even for sophisticated analysts, and a troublingly frequent pattern of projects being delayed, costs being much higher than estimated, and debt levels becoming unsustainable. While there are some genuine exceptions, the overall track record of the real estate development sector in India as a place for long-term investors to build wealth is not encouraging. The financial sector requires nuanced treatment. While some private sector banks and non-banking financial companies have been exceptional long-term wealth creators in India, the sector as a whole also contains many examples of companies that have appeared healthy for a period before revealing serious problems in their loan books. The author discusses in some depth how to distinguish between genuinely high-quality financial institutions, which tend to have conservative lending standards, transparent disclosures, and long track records of maintaining credit quality through multiple economic cycles, and those that merely appear strong during good times but are sitting on a mountain of bad loans that will eventually reveal themselves. Let us now talk about the concept of capital allocation, which is one of the themes that runs through the book, and that the author considers a critical factor in distinguishing great businesses from merely good ones. Capital allocation refers to how the management of a company decides to use the profit it generates. A company has several choices. It can reinvest the profit back into its own business, funding new products, new markets, or expanded capacity. It can pay the profit out to shareholders as dividends. It can use the profit to buy back its own shares, which reduces the number of shares outstanding and thereby increases the value of each remaining share. Or it can use the profit to acquire other businesses. The author argues that the quality of capital allocation decisions is one of the most important factors separating companies that compound wealth at high rates over long periods from those that compound at mediocre rates. A management team that consistently finds ways to reinvest profit at high returns, meaning into projects or expansions that generate genuinely good returns on the capital invested in them, will compound the value of the business at a much faster rate than a management team that either wastes capital on poor acquisitions or lets it pile up unproductively on the balance sheet. The worst form of capital allocation, in the author's view, is the poorly thought-out acquisition. Indian corporate history is full of examples of companies that had excellent core businesses generated strong cash flows for many years, and then destroyed enormous amounts of shareholder value by acquiring other businesses at inflated prices, in industries they did not understand well, or with management teams that turned out to be far less capable than they appeared. The author argues that investors should look carefully at the acquisition track record of any company they are considering for a coffee can portfolio, because a history of poor acquisitions is a warning sign about the quality and judgment of the management team. Conversely, a management team that has a strong track record of either reinvesting capital excellently into the core business or returning surplus capital to shareholders through dividends or share buybacks when there are no attractive reinvestment opportunities is a powerful positive signal. This kind of disciplined capital allocation is a sign of management maturity and a genuine orientation towards long-term shareholder value creation rather than short-term empire building. The author also discusses the role of debt in evaluating coffee can quality businesses. His general view is that the best long-term investments tend to be companies that carry relatively low levels of debt relative to their earnings power. A company that is very heavily indebted is vulnerable in several ways. In a downturn, when revenues fall, the company must continue making its interest payments regardless, which can create severe stress. A highly indebted company also has less flexibility to invest in growth opportunities when they arise, because its capital resources are already committed to servicing its existing debt. And high debt makes a company dependent on the continued willingness of lenders to roll over or refinance the debt, which can become a serious problem if credit market conditions tighten. The companies that have delivered the most consistent long-term returns in India have generally maintained very clean, conservative balance sheets with low debt levels or no debt at all, and strong cash generation that gives them the financial flexibility to invest in growth without needing to rely on external financing. This financial strength is both a result of the business's underlying quality and a reinforcement of it, because it gives the company the ability to invest through downturns and emerge stronger, while competitors that are more highly leveraged are struggling to survive. Now, let us spend some time on the question of valuation, which is a topic that many investors find confusing and that the author treats in an interesting and somewhat distinctive way. Valuation refers to the question of how much you should pay for a stock. Even a wonderful company can be a poor investment if you pay too high a price for it, because the price you pay determines the return you will earn. If you buy a genuinely great business at a very high price, the business needs to grow enormously just for your investment to break even, and if growth disappoints even slightly, you could end up losing money despite owning a high-quality company. The author acknowledges this challenge, but argues that for coffee can quality companies, the traditional obsession with paying the lowest possible price is somewhat less critical than it is for lower quality investments for an important reason. A company that can genuinely compound at 20% a year for 10 years will ultimately deliver strong returns even if you pay a somewhat elevated price at the start, because the compounding over the decade is powerful enough to overcome even a moderately unfavorable starting valuation. The bigger risk, in the author's view, is not paying a slightly high price for a genuinely great company, but rather avoiding a great company because the price seems high and then watching it compound at extraordinary rates for a decade without you. That said, the author does not suggest ignoring valuation entirely. He argues for a reasonable approach to price, meaning you should not pay prices that are so extreme that even the most optimistic growth scenarios would struggle to justify them. The goal is to find the intersection of quality and reasonable value, not to compromise on quality in pursuit of a lower price, but also not to pay any price regardless of how stretched the valuation might be. This is one area where the coffee can approach differs somewhat from pure value investing, the approach popularized by Benjamin Graham, the legendary American investor who was Warren Buffett's teacher. Graham's approach focused very heavily on buying stocks at prices significantly below their intrinsic value, looking for what he called a margin of safety in the price. The coffee can approach, while not ignoring valuation, places much greater emphasis on the quality of the business than on the price, and accepts that great quality tends to come at a premium price, one that is often still worth paying because of the compounding power of genuine excellence over a long period. Let us now turn to a discussion of the alternative investment options that most Indian investors actually use, and why the author believes the coffee can approach is superior to almost all of them. The most common place that ordinary Indians have traditionally stored their savings is in fixed deposits at banks. A fixed deposit is essentially a loan you make to a bank, and the bank pays you an interest rate for the use of your money. Fixed deposits are extremely safe, extremely simple, and extremely predictable. But they are also, over the long run, quite poor wealth builders, for a reason that many people do not fully appreciate. The interest rate on a fixed deposit is, at best, roughly equal to the rate of inflation, and sometimes less. What this means is that while the number of units of money you have after the fixed deposit matures is higher than when you started, the purchasing power of that money, meaning the amount of real stuff you can buy with it, has not grown meaningfully and may actually have declined. If inflation is running at, say, 6% per year, and your fixed deposit is earning 7% per year, your real return, meaning the return after accounting for inflation, is only about 1% per year. After paying taxes on the interest income, your real return might be zero, or even slightly negative. Over a long period of decades, this means that money kept in fixed deposits essentially maintains its purchasing power at best, but does not meaningfully increase it. You end up no richer in real terms than when you started. For people who are depending on their savings to fund a comfortable retirement, this is a serious problem because medical costs, food costs, housing costs, and all the other costs of living tend to rise significantly in real terms over a 30 or 40-year period, and savings that merely keep pace with inflation will not be adequate to meet these rising costs. Gold is another very popular investment among Indian households, which collectively own enormous amounts of it. The cultural and emotional attachment to gold in India is deep and real, and the author treats it with respect. But he is also clear that gold has not historically been an efficient store of wealth over long periods, at least not compared to a well-constructed equity portfolio. Gold does not generate any income. It does not pay dividends. It does not compound. It simply sits there and maintains its value in relation to currency debasement over very long periods, but it does not create new wealth in the way that a productive business does. Real estate is another enormously popular investment class in India, and the author discusses it in some depth. Real estate does have genuine advantages as an investment. Physical property is tangible. It can be used or rented, and it provides a certain kind of psychological security that financial assets do not. In many parts of India, real estate has also delivered strong returns over the past few decades, driven by rapid urbanization and a growing middle class that needed housing. But real estate also has significant disadvantages compared to a coffee can equity portfolio. The most obvious is illiquidity. You cannot sell a piece of real estate quickly and cheaply if you need the money. Selling a property typically takes months and involves significant transaction costs in the form of taxes, legal fees, and brokerage commissions. These transaction costs can easily amount to several percent of the property's value, which significantly reduces the net return. Real estate also requires ongoing management attention. Tenants need to be found, managed, and sometimes evicted. Properties need to be maintained and repaired. There are property taxes to be paid and regulatory requirements to be complied with. All of this takes time and attention and creates a kind of friction that does not exist with a coffee can equity portfolio, which you simply hold and forget. There is also the issue of concentration risk. Most Indian families who have invested in real estate have a very significant portion of their net worth tied up in a single property, or at most, a small number of properties. If the property market in their city declines, or if their specific neighborhood becomes less desirable for some reason, their entire savings can be affected. A coffee can equity portfolio, by contrast, is spread across 10 to 15 different businesses in different sectors and geographies, which provides a much greater degree of diversification. Mutual funds are perhaps the investment vehicle that most urban, educated Indians have some familiarity with, and the author treats them in considerable depth. His view is nuanced. He acknowledges that well-chosen mutual funds are a much better vehicle for most ordinary investors than trying to pick individual stocks without a rigorous framework. And he acknowledges that the mutual fund industry in India has delivered decent returns for investors over the past few decades. But he also identifies some serious structural problems with the mutual fund industry that limit its ability to deliver the best possible returns for investors. The first is cost. Most actively managed equity mutual funds in India charge management fees that, while individually modest, add up to a significant drag on returns over long periods. If a fund charges fees that reduce returns by 1 to 2% per year, and the power of compounding means that 1 or 2% per year compounds enormously over a decade or more, the total cost of these fees over a long investment horizon can be very substantial. The second problem is what the author calls index hugging. Because fund managers are judged relative to a benchmark index, and because their careers and reputations depend on not dramatically underperforming that index in any given year, most fund managers are very reluctant to build portfolios that look very different from the index. They tend to own many of the same stocks that are in the index, in roughly similar proportions, which means their portfolio performance tends to track the index fairly closely, minus their fees. This makes it very difficult for them to dramatically outperform the index over time, because they are essentially holding the index but charging more than the index would cost. A coffee can portfolio, by contrast, is completely unconstrained by any benchmark. If the best coffee can quality companies are concentrated in a few sectors, the portfolio can be heavily concentrated in those sectors, regardless of whether the index has such a concentration. This freedom from benchmark constraints, combined with the long-term time horizon that allows the compounding of genuinely great companies to work, is what gives the coffee can approach a potential edge over most conventional mutual funds. The author does acknowledge that index funds, which simply replicate the composition of a market index at very low cost, are a significant improvement over most actively managed funds for most ordinary investors. If you cannot or do not want to construct a coffee can portfolio yourself, investing in a low-cost index fund and holding it for a long period is a much better strategy than actively trading stocks or investing in high-cost actively managed funds. But the author's core argument is that a carefully constructed coffee can portfolio, built from the universe of genuinely high-quality businesses that pass the filters, can deliver returns that are substantially better than even a good index fund over a 10-year or longer period, because the best Indian businesses have historically compounded at rates that exceed the overall market by a significant margin. Let us now discuss what the author calls the importance of reading annual reports, and why he considers this practice so central to the process of identifying genuine coffee can quality companies. An annual report is the document that every listed company is legally required to publish each year, providing a detailed account of its financial performance, its business activities, its risks, and its future plans. Most investors never read annual reports. They rely on news articles, analyst reports, social media posts, or the recommendations of friends and colleagues to make their investment decisions. The author argues, very persuasively, that this is a serious mistake. Annual reports, read carefully and critically, contain an extraordinary amount of information about the true nature and quality of a business. The financial statements in the annual report, including the income statement, the balance sheet, and the cash flow statement, provide a comprehensive picture of how the business has actually performed financially. The notes to the financial statements, which are often long and dense, and which most people skip entirely, often contain crucial information about accounting policies, related party transactions, contingent liabilities, and other matters that can be extremely important for understanding the true financial position of the company. The chairman's letter, or the management discussion and analysis section, provides insight into how the management team thinks about the business, the challenges it faces, and its plans for the future. Reading these sections across multiple years allows you to assess how honest and accurate the management's communications have been, whether they have delivered on promises made in previous years, and whether their thinking about the business is thoughtful and long-term or shallow and short-term. The author recommends reading at least 10 years of annual reports for any company you are considering for a coffee can portfolio. This is a significant time commitment, and it is one reason why the coffee can approach is not as passive as it might first appear. The initial work of selecting the portfolio, which involves both quantitative screening and deep qualitative research, including the reading of many years of annual reports, requires genuine effort and expertise. The ongoing management of the portfolio, once constructed, is indeed very passive. But getting to the starting point of a genuinely well-constructed coffee can portfolio requires doing the homework properly. For investors who do not have the time, the inclination, or the financial expertise to do this kind of deep research themselves, the author suggests that one option is to invest with a professional manager who follows a coffee can or similar philosophy. The emergence of investment management firms in India that follow long-term, quality-focused, low-turnover investment approaches has given individual investors access to this kind of management, and the author naturally believes that this is a better option for most people than either trying to do it themselves with inadequate research or defaulting to conventional mutual funds that chase short-term performance. One of the most intellectually interesting parts of the book deals with the question of whether what worked in the past will continue to work in the future. This is always a critical question in investing because the future is inherently uncertain, and strategies that have worked beautifully in historical data do not always continue to work when everyone knows about them and starts using them. The author addresses this question thoughtfully. He acknowledges that the coffee can approach, or any investment approach, cannot be guaranteed to deliver the same returns in the future that it has in the past. The world changes, industries evolve, and what constitutes a genuinely durable competitive advantage can shift over time. He also acknowledges that if the coffee can approach becomes extremely widely known and followed, the prices of coffee can quality companies could become so elevated that even great underlying business performance would not translate into strong stock market returns because you would be paying too much at the outset. But he argues that there are strong structural reasons to believe that the fundamental principles underlying the coffee can approach, namely, that genuinely great businesses that compound at high rates over long periods will create vastly more wealth for their owners than average businesses, will remain valid regardless of market conditions. This is because the fundamental mathematics of compounding does not change. A business that genuinely grows at 20% a year for a decade will be enormously larger and more valuable at the end of the decade than a business that grows at 5% a year. And this difference in underlying business value will eventually be reflected in the stock price, regardless of short-term market fluctuations. He also argues that the behavioral advantages of the coffee can approach, the fact that it protects investors from their own emotional impulses, are likely to remain relevant for as long as human beings are the ones making investment decisions. Human psychology does not change quickly, and the temptations to trade, to panic, to chase excitement, and to follow the crowd will continue to plague investors for the foreseeable future. Any approach that provides a structural defense against these tendencies will continue to have value. Let us now discuss one of the more challenging aspects of the coffee can approach, which is how to handle periods of significant market turbulence. The 10-year holding period will, almost inevitably, include at least one major market downturn, quite possibly several. Watching the value of your portfolio fall significantly, sometimes by 30, 40, or even 50% during a severe bear market, is psychologically extremely challenging, and the temptation to sell and limit further losses is very strong. The author is direct and honest about this challenge. He does not minimize the psychological difficulty of sitting through a major bear market, but he makes a very powerful argument for why doing so is absolutely essential to the coffee can approach, delivering its intended results. The key insight is that market downturns are temporary, but the compounding of great businesses is permanent. Every major market crash in history has eventually been followed by a recovery, and the prices of genuinely great businesses have always eventually recovered and gone on to new highs. The investors who stayed the course through the downturns and continued to hold their coffee can portfolios were eventually rewarded enormously. The investors who panicked and sold during the downturns crystallized their losses and then typically missed much of the subsequent recovery, ending up significantly worse off. This insight is supported by extensive historical data. The author shows that an investor who had constructed a coffee can portfolio of genuinely great Indian businesses at various points in the past and then held through every subsequent market crisis, including the dot-com crash, the global financial crisis, and various India-specific episodes of market turbulence, would have ended up with far more wealth than an investor who tried to time the market, selling when afraid and buying when confident. The practical implication is that one of the most important things you can do to prepare for a coffee can investment is to manage your financial life in a way that minimizes the probability that you will be forced or tempted to sell during a market downturn. This means investing only money that you genuinely do not need for at least 10 years. It means maintaining a separate emergency fund that covers at least 6 to 12 months of your living expenses, so that you are never in a position where you need to sell your investments to cover an unexpected expense. It means being honest with yourself about your risk tolerance and not investing so much of your net worth in the coffee can portfolio that a temporary market decline would cause you unbearable anxiety. The author also discusses the importance of what he calls the right mental model for thinking about market downturns. Most investors think of a market decline as a loss, meaning something bad has happened to them. But the author argues that for a long-term coffee can investor, a market decline is actually an opportunity because it allows you to add to your existing positions at lower prices. If you believe in the long-term quality of the businesses in your portfolio, a lower price is simply a chance to acquire more of those businesses at a better valuation, which will ultimately enhance your long-term returns. This is a fundamental reframing of how to think about market volatility, and it is one of the most powerful mental shifts that the coffee can philosophy tries to bring about. Instead of dreading market downturns, the long-term quality investor should actually look forward to them, at least to the extent that they create opportunities to deploy additional capital into great businesses at attractive prices. Now, let us spend some time on the practical mechanics of how an individual investor might actually implement the coffee can approach in their own life, step by step. The first step is to assess your own financial situation honestly. How much money do you have that you can genuinely commit to not touching for 10 years? This might be a one-time lump sum, or it might be a commitment to invest a fixed amount every month for a period of time and then hold the accumulated portfolio for 10 years. It is important that this money is genuinely set aside for the long term and is not money that you might need for a house purchase, a child's education, or any other foreseeable expense within the next decade. The second step is to build your knowledge base. The coffee can approach requires understanding financial statements well enough to apply the filters correctly and to do the qualitative research needed to assess business quality. This does not require a formal education in finance or accounting, but it does require a genuine commitment to self-education. The author recommends reading not just this book, but a range of other books on investment, accounting, and business strategy in order to build the conceptual foundation needed to evaluate companies intelligently. The third step is to actually apply the filters to the universe of listed companies and generate your initial list of candidates. This requires access to historical financial data, which is available from various commercial databases or from the annual reports of individual companies. The process of applying the filters is somewhat mechanical, but it requires careful attention to the specifics of how each number is calculated to ensure you are making like-for-like comparisons. The fourth step is to do the deeper qualitative research on each company that has passed the quantitative filters. This involves reading annual reports, studying the competitive landscape, understanding the management team, and assessing the durability of the competitive advantages that have driven the company's historical performance. This is the most time-consuming and intellectually demanding part of the process, and it is where the quality of your final selections will largely be determined. The fifth step is to construct the portfolio, selecting the 10 to 15 companies from your researched list that you are most confident about and allocating your capital among them. The author generally suggests a roughly equal allocation among the portfolio holdings, rather than very highly concentrated positions in just one or two names, because even your highest conviction ideas carry uncertainty and some diversification is wise. The sixth step, and in some ways the most important, is to put the portfolio away and not look at it constantly. The author quite literally suggests that once the portfolio is constructed, you should resist the temptation to check it every day or even every month. Set up a reminder to review it once a year, primarily to check whether any of the underlying businesses have experienced the kind of fundamental deterioration that might warrant a reconsideration. Otherwise, let it be. Let time and compounding do the work. The author also discusses the question of what to do when new money becomes available for investment. If you are in the fortunate position of having additional savings to invest, you have a few options. You can add to your existing coffee can portfolio by buying more of your existing holdings. You can initiate a new coffee can portfolio using the current filtered universe of companies. Or you can invest the new money in a different vehicle, such as an index fund, while keeping your original coffee can portfolio intact. There is also a thoughtful discussion in the book about the role of coffee can investing in the context of an overall financial plan, and the author is realistic about the fact that most people need more liquidity and flexibility than the coffee can approach allows for their entire net worth. He suggests thinking of the coffee can portfolio as one component of a broader financial strategy, ideally the component allocated to long-term wealth building, while maintaining other assets in more liquid and accessible forms for shorter-term needs. Let us now discuss the philosophical underpinnings of the coffee can approach, because while the book is primarily about investing, it is also, at a deeper level, about a certain way of thinking about time, about patience, about the nature of excellence, and about what it means to build something truly lasting. The author is clearly influenced by the idea that in almost every domain of human endeavor, the things that are most genuinely valuable tend to be those that have been built carefully and patiently over long periods of time. Great works of art take years to create. Great scientists build their knowledge over decades of painstaking research. Great businesses are built through years and years of consistent effort, customer focus, and operational excellence. There are very few genuine shortcuts to lasting quality in any field. The same, he argues, is true of wealth building. The investors who have created the most extraordinary wealth over the longest periods are almost universally those who identified genuinely great businesses early, committed to them patiently, and then had the discipline to hold them through all the inevitable turbulence that the markets threw at them over the years. They did not try to time the market. They did not try to trade their way to riches. They simply found excellence, bought it, and held it, allowing time and compounding to do what time and compounding do best. This is a deeply countercultural message in the world of modern finance, which is dominated by a culture of activity, urgency, and the constant pursuit of the next big thing. Financial television is filled with breathless coverage of the latest market movements, the latest earnings reports, the latest analyst upgrades and downgrades, the latest geopolitical developments that might affect stock prices. This constant noise creates the impression that investing requires constant attention and constant response, that every news event requires a portfolio adjustment, that doing nothing is itself a kind of failure. The coffee can philosophy is a direct and explicit rejection of this culture. The author argues, backed by considerable data, that all this activity, all this trading, all this responding to the latest news and the latest market movements does not generate better outcomes for investors. On the contrary, it generates worse outcomes because it generates costs, both direct costs in the form of transaction fees and taxes, and indirect costs in the form of the emotional mistakes that active traders consistently make. The investor who successfully masters the coffee can approach is not just making a smart financial decision. They are making a broader philosophical commitment to patience, to trusting in the power of excellence to reveal itself over time, and to resisting the very human temptation to confuse activity with productivity. In the coffee can world, the investor who does the least is usually the investor who wins the most. The author also draws interesting parallels between the coffee can investment philosophy and the broader tradition of long-term value investing that has been practiced and articulated by some of the greatest investors in history. Warren Buffett, whose ideas are referenced frequently throughout the book, has famously said that his favorite holding period is forever. Charlie Munger, Buffett's longtime partner at Berkshire Hathaway, has spoken eloquently about the power of compound interest and the importance of simply not disturbing it unnecessarily. Philip Fisher, another legendary American investor, wrote about the importance of doing thorough research before buying a stock and then holding it for many years to allow the underlying business quality to compound. The coffee can approach, as described by Mukherjea, is, in essence, an Indian application of these universal principles of long-term quality investing, adapted to the specific characteristics of the Indian stock market and calibrated to the kinds of businesses that have historically generated the strongest and most consistent long-term returns in the Indian context. One aspect that makes the author's contribution particularly valuable is that he goes beyond simply articulating the philosophical principles, which have been articulated well by others before him, and provides a specific, data-backed, quantitatively defined framework for implementation. The 10% revenue growth and 15% return on capital employed filters are not arbitrary. They are derived from careful analysis of the historical relationship between these metrics and long-term stock market returns in India. This gives the coffee can approach a degree of rigor and operationality that makes it genuinely actionable for a serious investor, rather than just an aspirational philosophy. The book also contains a great deal of valuable discussion about the Indian economy more broadly, and why India provides such a fertile ground for the coffee can approach specifically. The author points out that India is at a stage of economic development where a certain set of structural tailwinds are creating very favorable conditions for certain kinds of businesses. India's population is enormous, young, and rapidly urbanizing. The middle class is growing at a significant rate. Per capita incomes are rising. Literacy and education levels are improving. Digital infrastructure is being built at an impressive pace. All of these trends create powerful demand dynamics for consumer goods, healthcare services, financial services, and technology, the very sectors where many of the best coffee can quality companies tend to be found. At the same time, Indian society is becoming steadily more formal in its economic organization. The implementation of the Goods and Services Tax, better known as the GST, has disrupted many informal sector businesses and created opportunities for their formal sector counterparts to take market share. The growing availability of digital payment infrastructure has opened up new channels of commerce and finance. The formalization of the Indian economy is a powerful secular trend that tends to benefit the large, well-governed, formally operated businesses that dominate the coffee can universe at the expense of smaller, informally operated competitors. The author also discusses the role that improvements in corporate governance in India have played in making the coffee can approach more relevant over time. While corporate governance in India still has significant room for improvement in many areas, there has been a clear and meaningful trend towards better disclosure standards, stronger regulatory oversight, and greater accountability of management to shareholders. This trend benefits genuinely well-governed companies by making it easier for investors to identify them and by reducing the competitive advantage that less scrupulous companies might previously have gained through opacity and creative accounting. Looking at the big picture, the author paints a picture of India as a country that is transitioning, albeit unevenly, and with many challenges along the way, from an economy dominated by government-owned enterprises, family-controlled conglomerates, and informal sector businesses, to one where high-quality, formally governed, professionally managed businesses are increasingly able to grow and prosper. This transition creates an exceptionally favorable environment for the coffee can approach because it means the universe of companies that genuinely meet the coffee can standards is likely to expand over time, even as the specific composition of that universe shifts and evolves. Let us now discuss some of the challenges and limitations of the coffee can approach, because the author, to his credit, is not purely promotional about the strategy he advocates. He acknowledges honestly where the approach has limits and where it requires the investor to be realistic about the uncertainties involved. One significant challenge is the identification risk, meaning the risk that the filters do not perfectly distinguish between genuinely great companies and companies that merely appear great based on historical numbers. A company can have a 10-year track record of strong revenue growth and high returns on capital and still be heading towards a serious deterioration in its competitive position that the historical numbers have not yet revealed. Industries can be disrupted by new technologies or business models in ways that no one fully anticipated. Management teams that were excellent can become complacent or make a series of poor decisions that erode the company's position over time. The author's response to this challenge is the importance of the qualitative research layer that sits on top of the quantitative filters. Doing the deep work of understanding the competitive dynamics of the industry, the nature and durability of the company's competitive advantages, and the character and track record of the management team is meant to provide an additional layer of protection against these risks. But he is honest that no amount of research can eliminate uncertainty entirely, and that the coffee can approach, like all investment approaches, involves accepting some degree of risk in exchange for the opportunity to earn superior returns. Another challenge is what the author calls the patience problem. Even investors who intellectually understand and agree with the coffee can philosophy often struggle to maintain the necessary patience in practice. When a stock in the portfolio has not moved for 2 or 3 years, while other stocks seem to be going up rapidly, it is very easy to start doubting whether the approach is working and to feel tempted to switch to a more exciting strategy. When the overall market is going up strongly and the coffee can portfolio is underperforming in the short term, the psychological pressure to change course can be intense. The author emphasizes that these periods of underperformance or of seemingly slow progress are a normal and expected feature of the coffee can approach, not a signal that something has gone wrong. The strategy is designed to deliver over a 10-year period, not to win every quarter or every year. Short-term underperformance relative to the market is a cost that you pay in exchange for the discipline of not engaging in the market timing and stock switching that destroys returns for most investors. But this cost, while real, is far outweighed by the long-term benefits of staying the course. The author also acknowledges the challenge of sector concentration risk because the coffee can filters tend to favor certain sectors, particularly consumer goods, private sector financials, healthcare, and technology. The resulting portfolio is likely to be less diversified across sectors than the broader market. In periods when these favored sectors are performing poorly while other sectors are performing strongly, the coffee can portfolio may significantly underperform the index. This can be psychologically challenging and requires genuine conviction in the long-term thesis to weather without making changes. Despite these challenges and limitations, the overall message of the book is powerfully optimistic. The author believes genuinely and deeply that the coffee can approach offers ordinary investors who are willing to do the work and exercise the discipline a path to truly meaningful, long-term wealth creation. One that does not require special connections, does not require superior intelligence, and does not require constant monitoring or sophisticated trading. What it requires is patience, discipline, rigor in selection, and the intellectual courage to ignore the constant noise of the market and trust in the fundamental power of great businesses to compound value over time. The concluding message of the book is, in many ways, a call to rethink entirely how you think about money and investing. Most of us have been trained by the media, by the financial industry, and by cultural norms to think of investing as an active, exciting, constantly changing process, one that requires us to stay plugged in to the latest news, to respond quickly to events, and to always be looking for the next opportunity. The coffee can philosophy challenges all of this. It says that the best investment decision you can make is often to do less, not more. That the best stocks to own are usually boring, steady businesses that do the same things year after year with consistent excellence, not exciting, story-driven companies that generate headlines. That the best time to sell is almost never, as long as the underlying business quality remains intact. And that the most powerful force in investing is time, specifically, the time you give to the magic of compounding to work on genuinely great businesses. These are ideas that are easy to agree with intellectually and very hard to follow in practice because they go against almost every instinct that the modern financial environment cultivates in investors. But the investors who have managed to internalize these ideas and to follow them consistently have, without exception, been rewarded with wealth creation that the active traders and market timers could only dream of. There is a broader human lesson embedded in this book, one that goes well beyond investing. It is about the value of patience in a world that increasingly celebrates speed. It is about the power of focusing on genuine quality rather than superficial excitement. It is about trusting in processes and principles rather than reacting to every piece of information that comes your way. It is about the wisdom of knowing when not to act, of understanding that sometimes the most productive thing you can do is simply to wait. These are lessons that apply not just to how you manage your money, but to how you manage your career, your relationships, your health, and your life. The discipline and patience required to be a successful coffee can investor are, in a real sense, the same discipline and patience required to achieve anything truly meaningful over a long period of time. The author's deep knowledge of Indian business and his many years of experience managing money professionally shine through on every page. This is not a book written by an academic theorist who has never actually managed real money for real clients. It is a book written by someone who has spent decades in the trenches of the Indian investment world, who has made mistakes and learned from them, who has seen strategies fail and strategies succeed, and who has distilled all of that experience into a framework that is both intellectually rigorous and practically actionable. The writing is clear, the examples are concrete and relevant, and the arguments are made with both passion and evidence. Whether you are a complete beginner who is just starting to think about investing your savings, or an experienced investor who has been managing a portfolio for years and is looking for a more coherent long-term approach, this book has something important to offer you. For the beginner, it provides a complete and coherent framework for thinking about long-term wealth creation through equity investing, one that is rigorous enough to be taken seriously, but accessible enough to be genuinely understood without a background in finance. For the experienced investor, It provides both a challenge to rethink some deeply ingrained habits and assumptions and a practically usable methodology for identifying and holding the genuinely great businesses that will compound wealth over the long term. If there is one central insight that you should take away from this entire book, it is perhaps this: time in the market, not timing the market, is what creates wealth. Owning genuinely great businesses, not frequently trading in and out of mediocre ones, is what builds lasting financial security. And the patience to hold great businesses through all the noise and turbulence of a decade of market activity is not a passive act of surrender. It is an active and difficult choice that requires genuine courage, genuine conviction, and genuine wisdom. The coffee can, that simple container sitting quietly on a shelf somewhere, accumulating value year after year without anyone paying attention to it, is not just a metaphor for an investment strategy. It is a metaphor for a whole approach to life, one that values depth over speed, substance over flash, and long-term excellence over short-term excitement. In a world that seems increasingly obsessed with instant gratification and constant novelty, there is something almost radical about the coffee can philosophy. And yet, as Saurabh Mukherjea shows, with compelling data and clear reasoning, it is precisely this apparent radicalism, this willingness to do what almost no one else is willing to do, that is the source of its extraordinary power. The investors who will build the greatest wealth over the next decade and beyond are not the ones who will trade the most cleverly or follow the most sophisticated strategies. They are the ones who will find the best businesses, buy them, and then have the wisdom and the discipline to simply leave them alone, letting time do what time does best, which is to turn good decisions into great outcomes, and great outcomes into extraordinary legacies of wealth. That is the promise of coffee can investing, and it is a promise backed not by wishful thinking, but by decades of carefully documented evidence from one of the most dynamic and challenging equity markets in the world. Pick the right businesses, build the right portfolio, and then, above all else, have the patience to let it grow. If you read this summary and feel a spark of recognition, a sense that this approach resonates with something deep in your own understanding of how wealth is really built, then the next step is clear. Read the book itself, absorb its full depth of research and argument, and then begin the serious and rewarding work of putting its principles into practice in your own financial life. The best time to start was 10 years ago. The second best time is today.